Good evening, Life and Figures viewers, and good evening, Benjamin. We have a quick video for our viewers just regarding the past week of events. We saw huge turbulence in the global markets. Firstly, we had three of the major central banks, namely the Bank of England, Bank of Japan, and the US Federal Reserve, each opting to take a different stance. So firstly, we had our Bank of England that cut rates by 25 basis points. The US Federal Reserve kept their rates unchanged at 5.5%, but both of those decisions were in line with expectations. That isn't what shocked the market. The big shock was the Bank of Japan that hiked rates from 0.5%, that hiked rates to 0.5% from 0.1%. Now, the viewers are probably wondering why such a small hike would shake up things as much as it did. Now, Japan is sometimes overlooked in the global markets, but few know that they actually hold the most US treasuries out of all the nations. And the most important thing regarding Japan is the Japanese yen is the main vehicle for the global carry trade. Now, to simplify it, the carry trade is basically investors borrowing in yen at a near 0% interest rate, swapping the yen into a dollar, and then using that dollar to go and buy a risk-free US government bond that yields north of 4%, like it's doing at the moment. So viewers, as you can see, they're borrowing at a near 0%, but then they invest at less rounded off to 4. You can see the interest rate differential between these two. That is kind of a risk-free return that the investors earn. But that is only in the case that the currencies remain stable. Because remember, when investor has to repay the loaned funds, the borrowed funds, he has to buy yen, he has to buy back yen to clear the trade. So that's basically the essence of the carry trade. And by the Bank of Japan increasing rates, you can see how that's squeezing the margin that the traders make. But on Friday, the US unemployment rates, the US unemployment figures, the non-farm payrolls, was way lower than expected, showing a slowdown in the US economy. And that increased bets that the Federal Reserve is going to cut rates. So this is now both, so the yen is increasing rates and the Fed is expected to cut rates. And that's squeezing the carry trade margin. So in a quick few sentences, that is what rocked the markets this week. Yeah.
So, to the listeners, I think it's quite in the evening. So, but yeah, whenever you say it, good day. So, Christopher, so now to round up which you've said. So, the sell off that we have seen in the US stock market, whereby you talked about the US jobs now, we've seen that there was a decrease. I mean, the figures came in at numbers that were not expected, meaning
Yeah.
that implying that there could be a growth concern. And we've also seen that what's that metrics? Oh, the unemployment as well
Yeah.
rose up again, signaling another no confidence into their market and a bit of recession. Could it be
Yeah.
adding to the sell-off that we've seen in terms of the US stock market as well last week? Because it was quite a bloodbath. The markets did bleed a lot.
Yeah. So I think just to clarify to the viewers, so the non-farm payrolls is a statistic that the Federal Reserve uses to judge employment in the US. So on the first Friday of every month, they release all the jobs that was added in the US economy, not including the agricultural sector. So that's why it's called non-farm payrolls. So all the new people that came onto the payroll of the US economy in the past month. So in July, it fell to 114,000, down from 179,000 in June. But before we jump into the stock market, I quickly want to illustrate to the viewers why and how this carry trade is unwinding. So just to touch onto the carry trade again, so the viewers must just remember that when you take the carry trade, you are essentially shorting the yen because you are borrowing in yen and then you are converting it to another currency. So you have to sell your yen first. So that is what we have seen since the US started hiking rates. The Bank of Japan didn't hike rates with the rest of the central banks. And as you can see, the pressure mounted on the Japanese yen. In 2023, there was some relief that came in with the Bank of Japan intervening in the currency markets. However, when the narrative of the Fed being or staying higher for longer with the interest rates, the Japanese yen continued its slide. But as you can see now, the past 4 weeks, the Japanese yen has strengthened tremendously, almost 8% against the US dollar. Now, this is basically the investors selling. They have to close their positions now. So that means investors have to buy back their yen to repay the borrowed funds. So as you can see now, obviously there's buying pressure behind the yen, and that is what's pulling down the yen, or pulling down the USD JPY pair. But now to touch on the stock market, most of this, instead of just taking your carry trade funds and investing in a low risk asset vehicle like a US Treasury, there is suspicion that investors would have taken these borrowed funds and invested it into more risky. You can obviously increase your risk. You can take that money instead to the stock market. You can maybe take that money and instead of buying a US government bond, you buy a South African government bond. The South African government bond yields north of 10%, and the US one around 5%. So that is the trade-off. So what we are seeing now, the sell-off is firstly, it is carry trade driven, the S&P 500. However, we are also seeing a massive drop in US bond yields, and the US yield curve is steepening. So that's almost signaling that investors are swinging. So they are putting the inflation fears that we had previously are swinging to growth fears, because there are signs that the economy is slowing and the recession is upon us. So funds are now moving from the risky equities and they're running into the bond market. So if I can just bring up the next chart is just going to take, it is our federal funds rate in blue, and then the candles that you see is the US 2-year yield. So as you can see, the Federal Reserve controls the short end of the yield curve, right? When the Fed is expected to cut rates, the bond yields drop, and that is what we've seen the past 4 months. Yeah, the past 4 months. These are monthly candles because it dates back all the way to the 90s. The past 4 months has seen this yield curve drop off. And that is showing that investors are expecting the Federal Reserve to cut rates. Now, all the expectations are for a September rate cut, but this is the lay of the land at the moment. And one important thing that we have to highlight from this chart, the Federal Reserve always cuts into a recession or global or financial stress environment. They cut into this environment in order to add liquidity into the frail system, We saw that in the dot-com bubble in the year 2000. Obviously, the great financial crisis, they had to cut rates to alleviate the strain on the economy. And we also saw that in 2019 when the repo rate crisis in September 2019 hit the US, hit the major US banking market. So that is the lay of the land at the moment. I
Okay.
am
So,
not so I'm against the soft landing narrative. If history is to rhyme or repeat, there's not going to be a soft landing. So yeah,
okay, so investors are already pricing in um, a cut in the interest rates, and then but we know that the US doesn't ordinarily cut their interest rates in a way. To your point, to saying history, if history was to hold, we know
yeah,
that should there be a major crisis, like if you're not so leaning towards the soft landing, that will
yeah.
signal that things are very bad if they were to do it in September, and hence we are seeing also this disparity that we are seeing now.
Yes, yes. I honestly think the Fed is only going to start rates until there is a financial stress event. And I just quickly want to shift to the yield curve, the inversion of the yield curve. So, um, in a normal economic environment, a long term bond, like a US 10-year bond, should yield more than a US 2-year bond. It's basically the time value of money. You know, you're tying your funds up for longer, you want to be, the yield should be higher. However, when a yield curve starts to invert, it is a it's almost a sure sign for a recession, because investors are now move their funds to the long end of the curve because of the uncertainty over the short term. Now, in this example, you get lots of different yield curve spreads, but in this example, we're using the US 10-year and the US 2-year. Okay, so it's basically just the yield on the 10-year minus the yield on the 2-year. If this inverts, it means the 10-year is less than the 2-year. Now, every time the yield curve has inverted, there has been an economic stress event. Okay, again, here's the 2019 repo rate crisis, and then we saw the COVID pandemic, and our yield curve has been inverted since the end of 2022, right? And as you can see, the yield curve is starting to steepen, meaning that it is it is normalizing. And the only way that this thing normalizes is if the Fed pulls down the short term, like we saw on the previous chart. So that is that's a very important thing to watch. People always the stock market always takes the headlines, but you have to look at what is the bond market doing. The bond market is the underlying foundation of the current financial system that we have. And what it is clearly showing is the market is expecting the Federal Reserve to drop the short end of the curve, and there is buying pressure into bonds now. But obviously, that is coming at the expense of the stock market. Um, Speaking of the last 3 weeks, we have seen a steep drawdown in the stock market. However, in the bigger scheme of things, it is a minor blip given where we're coming from, if that makes sense. So I think there's still a lot of downside potential on the stock market. Um, but if the Federal Reserve manages to cool the volatility, the VIX, if the Federal Reserve manages to suppress the VIX by cooling the bond market, we can the music can continue playing. The music isn't going to stop just yet. I won't like call. I don't want to be a crash caller, but I think some pullbacks are necessary. Um, and then yeah, that's how I see it now.
So for this pullbacks to happen, uh, what do you reckon needs to happen, and what is likely, and also to touch base on the bond market now being the key decision thing, like to understand whether
Yeah.
there's going to be recessions. Like you'll have leading indicators like your bond market telling you
Mm.
if that's likely or not. Like, for example, we know bonds are used in monetary policy instances in terms of controlling the money supply. Should
Yeah.
you
Open
know?
market operations.
From market operations persuasions. So, in a way of wrapping up the market overview for the week, how do you see that play? How do you see pullbacks playing? Is it something likely this week or more to happen? And do you consider what we have seen last week to be quite significant, that it could influence rate cuts, considering that now investors are more worried about economic growth prospects, and we know that cutting interest rates will in a way induce money supply and induce demand, and then output picks up? Or do you think that they will still maintain their higher for longer and still hold interest rates with the aim of stabilizing the currency as well?
Yeah. So look, the Federal Reserve is going to maintain the tune that they first want to reach their inflation targets. Okay, they're going to continue singing that tune because that is what keeps their reputation. Their reputability is on the line here. Central banks have received a massive blow to their reputation over the past 4 years. Inflation has run wild across all economies in the world. The middle class is being squeezed. Purchasing power of the fiat currencies that we use are depreciating at an enormous pace, and it's too much to ignore now. You can show your CPI numbers of 3%, 4%, in South Africa's case, roughly 5%. But the population knows, the population are seeing through this. And I think one thing that we can expect from the Fed, they're going to continue singing the tune that they are still here to reach the inflation targets, right? However, if there is a massive stress event, if this reverse carry trade continues, meaning that we see a massive yen appreciation, uh, margin calls causing investors to sell off their risk assets, to close their positions, and we see a stock market that tumbles, more than 30% from our current highs, then we may very well see the Fed being forced to cut. But for now, I can assure you they are going to stick to their tune of trying to reach their inflation targets. The week ahead doesn't have a lot of data releases, so the markets will be able to digest what we saw last week. However, there are two extremely important events. It's not data events, however, it's the US bond auctions. So the US Treasury, they're going to have their 10-year bond auction and the 30-year bond auction. If there is strong demand behind these bonds, then it could signal that there is that the Fed can continue to taper their balance sheet. If, however, there isn't as strong demand for these bonds, then it's going to be difficult for the Fed to taper their balance sheet. Now, the chart that I'm showing to the viewers now, this is basically the Federal Reserve's balance sheet over the years. Okay, so in 2000, now when I say balance sheet, the central bank is allowed to be the lender and buyer of last resort, which means if investors don't want to buy a government's debt, if they think it's too risky, or the rate that the yield that they receive on those bonds aren't high enough, investors aren't going to buy it. Then the central bank can step into the market with printed money, buy up the bonds, suppressing interest rates. That's the recipe for QE, and that the modern monetary theorists, that's their game plan. I like to refer to modern monetary theory as magic money theory. But yeah, so this is the magic money theory at work. So you've seen is that so the Federal Reserve climbed into the U.S. Treasury market, uh, and they continued to do so up until 2016. That's when they started what they called the balance sheet taper. So now the Reserve Bank, well, the Federal Reserve in this case, has to sell these bonds back onto the market. Now, the pandemic has seen an exponential boom in the amount of bonds that central banks own. Okay. Now the Federal Reserve is starting to sell these bonds off. There was a short blip where the Fed had to support the market in last year's US banking crisis, but the taper has been steadily continuing. So the Federal Reserve selling these bonds back onto the market. But we all know the debt situation of the US Treasury. There's lots of criticism about the US being over indebted. I saw a stat the other day. I think almost 70% of the revenue that's being generated through the taxpayer is being used to pay interest on debt by the US. So yeah, it's going to be difficult for the US to continue bringing treasuries to the market, you know, um, and not having the Federal Reserve to backstop it. So that's an important thing to watch. Is there still demand for treasuries? And if there is, the Federal Reserve can continue to taper. If there isn't, that is what's going to stop the music. You know, in this whole game of musical chairs, that's what's going to stop the music, is if the Federal Reserve can't taper the balance sheet anymore and they have to step back in. And just to conclude, if the Federal Reserve starts cutting rates into the current inflationary environment that we have, there is a possibility of what they call a crack up boom hyperinflationary environment. Because if the Reserve Bank steps into, or if the Federal Reserve steps into the market with new, freshly printed money, dropping interest rates again, you know, turning on the money printers and the QE machine, again, while inflation is still prevalent, it can, I think it can seriously damage the reputation of central banks, and rightly so. I think inflation can run away. So that's one thing that the Federal Reserve will keep in mind. But the Federal Reserve has never let markets take their course. Take their course. The Federal Reserve always steps in to manipulate and to suppress and to intervene in the currency markets. So yeah, that's your best bet, is the Federal Reserve stepping in to intervene, and hopefully, you know, patch some more plaster over the broken drywall.
No, thanks for that. Thanks for that, Gustav. I think it does paint a picture of where we are likely headed, and on a case by case situation, and what's likely and not likely. But we will keep on reviewing this point as we have this market outlooks.
Yeah.
And yeah, that was quite amazing, and how you unpacked this. And yeah, I
Yeah,
know
yeah,
in
yeah.
terms
The
of
market report will be out as well,
yeah,
where we touched on this point.
yeah,
And if I can recommend a documentary to all the readers and the viewers, it's called Princes of the Yen by Richard Werner. It's an hour and a half documentary, really worth looking into that if you really want to see the power that central banks have over economies.
yeah,
Yeah, and the chart that I'm showing now is just gold. That's one thing I just forgot to touch on, is gold has ripped past its all-time highs, and it's currently sitting steady at $2,400 an ounce. And yes, Ben, I saw a scary stat the other day. So I was speaking to my parents about, investing in Krugerrands. And Benjamin and myself, we were born in 1996. And the price of a Krugerrand in 1996, with the year Benjamin and I were born, I think was like 1,600 Rand for a full ounce. Now, if you want to buy a full ounce of or a full ounce Krugerrand, it's it's sitting around 45 to 48,000 rand, right? And I actually did the math. That is a per annum return of 93%. If you are South African and you bought gold, just through from in the year 1996, I took the year that I was born, like hypothetically, um, and that yielded a return of 93% per annum. So that's just one thing that I want to highlight to South Africans is if this house of cards and risk assets start depreciating, the rand can come under serious, serious pressure. So for you to protect yourself, it is good to have a dollar denominated asset, such as gold. Um, some people also make the case for Bitcoin since it is a dollar denominated asset, but not everyone has that risk appetite. But just quickly touching on the rand has been relatively steady these last 4 weeks in this whole pull down, pullbacks that we saw in the dollar, the turbulence in the bond market. So that is at least a positive thing, and it is currently sitting on this long-term trend line. If the rand manages to keep the pair below 1840, we can actually see a drop below this red resistance line around 1780. And I think a best case scenario for the rand for this year is 1750, 1742. This 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 rate over here. However, there's always a however within economics. If we break above this orange line, which is the 50 week moving average at 1867, then we can see our rand fold again. But that will only happen if we see major, major stress in the global economy. So our Reserve Bank and those guys, they have their work cut out for them because, in my personal opinion, they have completely failed in their dual mandate to protect the purchasing power of our currency.
Yeah, no, there was a lot of factors that led up to that. As you know, interest rates only impact the demand side of things, and the supply side of things as well was also dampened. And as they always say, gold is king. Gold is king, and it's a safe haven site. There's been tons and tons of papers and research on gold in times of uncertainty, and what we have seen with it now reaching all-time highs and its price almost doubling up week in and
Yeah,
week out. It really shows that now what the market sentiment is really like out there. So yeah, these are
mm,
quite uncertain times, and but yeah, the market will self-correct. The invisible hand, we
yeah.
shall see.
Let's hope so. Let's hope so.
No,
Okay,
thank you
that's
guys.
all from my side. Yeah.
Yeah, thank you for tuning in, and yeah, for being with us through this journey. And till we meet again in another episode of the market overview or whatever is happening in the economy. And yeah, because anything can happen at any time, and we will be there to break it down into smaller parts. And thanks once more.
Okay, cool. Cheers, Ben. Cheers, viewers. Thank you.